ओके सो कहानी शुरू होती है जब मैं 20 साल का था एंड मैं कॉलेज में था। मैंने अपने नेबर को ट्रेडिंग से पैसा कमाते हुए देखा एंड उसने अपना घर बना लिया था, उसने बड़ी गाड़ी ले ली थी, तो मैंने भी ट्रेडिंग करनी शुरू कर दी।
आई थॉट कितना ही मुश्किल होगा, मतलब इतने सारे इन्फ्लुएंसर्स पैसा कमा रहे, इतने सारी टिप्स और ट्रिक्स है, मतलब कुछ ना कुछ तो हो ही जाएगा ना।
In the beginning, I got lucky. In the start, I made some quick profits in F&O trading. I was fooled into thinking that I could have a second income.
2-3 साल में मेरे टोटल 15 लाख डूब गए।
आई नेवर थॉट आई विल बी वन ऑफ दोज पीपल जिसका लाखों में लॉस हो जाता है और फिर वो फंस जाते हैं। यू ऑलवेज थिंक ना कि मेरे साथ तो कभी होगा नहीं है, कि मैं इतना स्टूपिड थोड़ी हूँ।
So the losses started piling up. I lost around 50,000 in just a couple of minutes.
सो अब मैं 12 घंटे की जॉब करता हूँ। एट द एंड ऑफ द मंथ मेरे को 55,000 मिलते हैं।
In my opinion, if you want to spoil your happy life, if you want to be ashamed of yourself, just trade.
This is such a common and sad story. And these people you just saw are among the 73 lakh individual traders in India right now who lost most of their money to the stock market in 2024. And chances are you are one of them. 7 out of 10 intraday traders in India lose their money. And this is way worse in the futures and options where 93% of all traders lose money. That is 9 out of every 10 people walking into dangerous territory, booking an average loss of 1.6 lakh rupees per person. And it gets darker. From 2021 to 2023, out of 113 lakh people that traded stocks, 105 lakh people faced losses. Out of this, 11,000 people lost more than 1 crore rupees. And only 1% made a profit of more than just 1 lakh. For the last 5 years, majority of finance YouTubers would have told you that you can get rich trading.
स्टॉक मार्केट में पैसा बनाना सबसे आसान है, आपको दिमाग नहीं लगाना। अगर आप दिमाग लगाओगे तो पैसा नहीं बनाओगे।
They say that you just have to buy this one stock, make this one trade, and maybe you can become a crorepati like them. But every year, there is a SEBI report. And every year, 89 to 93% of individual traders lose lakhs of rupees. And this continues to get worse. So why is it that so many people are losing so much money every year? And if you are losing, someone else is winning. So who are the winners and where is your hard-earned money going? And is beating the market even mathematically possible? If not, why do lakhs of Indians still keep trading? And lastly, if you had to build wealth in the stock market, what are the steps you should follow to beat the system? My name is Lavina Kamath and here's the full disclosure. We're very excited to be a part of the Zerodha Media Network. Together, Zerodha and we will bring you well-researched videos on careers, different industries and the evolving job market. So I wasn't able to wrap my head around why more than 90% of traders lose money. Everyone says it's psychology or discipline, but somehow that didn't feel right to me. You are told you can win in the stock market if you can read charts and master your emotions. But in reality, the game is far beyond any of that. The problem is deeper. The game itself is designed and run by much bigger players. They make the market that you and I are constantly trying to predict. So stay with me. I'll try and explain this to you with a simpler example. And for this, let me take you to a market where the only product to trade is berries. You ask different vendors and find out that prices are between 20 to 25 rupees per kg. That's the natural range from lots of small buyers and sellers. Now in the middle of this market is a big wholesaler. Remember him, he's important to the story and you'll understand why in just a minute. This wholesaler buys his berries from farmers. He always sells his berries to the retailers who then sell the berries to customers like you and I. He always shows two prices, a buying price and a selling price. On a normal day, his board or his order book says, I buy at 18 rupees per kg, I sell at 22 rupees per kg. His spread or his profit band is 4 rupees. Now farmers who cannot find a better deal elsewhere, they go and sell to him at 18 rupees. And retailers who want a guaranteed supply of their berries, they buy from him at 22 rupees. Small stalls that are placed around this fruit market also end up pricing at 20 to 25 rupees because they are roughly anchored by his quotes. He doesn't fully control the market, but he quietly anchors it. Now, 1 year, heavy rains and disease ruin a lot of the berries. Supply has collapsed, but retailers and customers like you still want to buy their stock of berries. The wholesaler knows that berries are now scarce and valuable. So if he keeps his price the same at 18 to 20 rupees, he knows his stock will be emptied out instantly and he won't make enough money. So here is what he does. He slides his entire pricing range up but keeps a similar profit spread. His new bid is 28 rupees per kg and his new ask is 32 rupees per kg. So now farmers get more and retailers pay more, and you eventually pay 35 to 38 rupees instead of the earlier 20 to 25 rupees. The wholesaler's per kg spread is still the same at 4 rupees, but the entire market has been repriced higher. By continuously updating his bid and ask, he translates the supply shock into a new, higher price range. Now, why am I telling you all of this? Because the stock market is basically the berries market, except it's digital and it happens in milliseconds instead of days. The big wholesalers in the stock market are firms that control the market. These are the big players who sit in the middle, and they are called the market makers because they always post two prices, bid and ask. They continuously nudge them up and down as orders hit, and they risk changes, and they decide how tight the spread is and how much size or stock sits at each level. You and I are the customers and small stall owners in this market. We come in wanting to buy or sell, but we don't choose the prices. We mostly accept whatever is currently being quoted in the market. So we don't set the price, the market makers do. And once I understood how the market makers operate, I finally realized that these charts and patterns are not driven by our psychology or purely economics. These market makers can change price or just exit their stocks, widen their profit band, hide or show size, and hedge in ways that push extra orders into the stock. And that is what creates violent moves that you start to see as patterns. And that is when I finally understood that your pattern reading is trivial. You're reading patterns that they have already produced. Trying to beat them with chart shapes alone is like trying to outsmart the berries wholesaler by studying yesterday's price board. Once I understood this, it became clear to me that you think that in the stock market, one person loses so another person wins. You think it's a zero-sum game. What I have now realized is that it's not a zero-sum game, it's a negative-sum game for us, where most of us lose and the market makers win. But let's suppose you're different, you're smarter. What if you actually understand how the markets work beneath the charts? Does that mean you finally get an edge and you can start making money from trading? Before we move on, I want to take a moment to thank our sponsor, Zoho Workplace. A lot of the dysfunction you see in Indian workplaces, which is miscommunication, silo teams, information being buried across 5 different apps, it all comes down to fragmentation. And that is the exact problem Zoho Workplace is built to fix. It's an all-in-one suite: emails, documents, spreadsheets, presentations, video calls, instant messaging, and cloud storage, all under one roof. No ads, no selling your data. And the only way Zoho makes money is from what you pay them. It's also trusted by the government of India. NIC India uses it for 2 to 5 million users across their departments. And that's not a marketing claim, that is a procurement decision made by people who are taking their security seriously. What makes it practical for teams of all sizes? You don't have to rip and replace everything overnight. The hybrid setup lets you run Zoho alongside Gmail or Outlook, and it lets you migrate at your own pace. Pricing is mix and match, different plans for different users, so you're not overpaying because one plan does not fit everybody. And if you need any help, you get 24/7 support from actual humans and not bots. Check out Zoho Workplace using the link below and start your free trial today. Now back to the video. When you open your Grow or Kite account and place an order, make a trade, you may feel like you're competing with other people just like you. You assume that if you carefully track the news, politics, the RBI, you will be able to book a huge profit. But I hate to give you the bad news. In the financial year of 2024 alone, individual traders like you and I lost over 41,000 crores in futures and options. But you know who made the money? Proprietary traders. They booked roughly 33,000 crores in gross profits, and similar traders from abroad, which are foreign investors, booked another 28,000 crores. Let that sink in, because individual traders lost 41,000 crores. Proprietary traders are professionals. They have tools and resources that you have no idea existed, like co-location servers. These servers let trading firms physically house their servers close to a stock exchange data center like NSE or BSE in India. Their orders travel in a few milliseconds instead of traveling on the global internet like yours and mine. They have real-time market data with tick-by-tick updates, whereas on your Zerodha or Upstocks app, the feeds are delayed by seconds. And even if it is just seconds, it can mean crores worth of transactions for the stock market. Proprietary traders can place, modify, and cancel thousands of orders per second. They have teams of quantitative researchers and data scientists building models to predict just small changes. And did you know that most trading that's done today is actually happening from, to, and between computers? And guess who's using them? That's right, proprietary traders. Out of the 33,000 crores they made in profits, 96% of those profits came from trades that were executed entirely by algorithms without any human intervention. Now think about this. What do you and I use to trade? A phone, 5 influencers, and just our own limited understanding of the market. This is exactly like walking into a casino which not only sets the rules but also knows your every move before you make it. You are trading in thousands or maybe a few lakhs. They are running strategies across the entire market with capital that can run into thousands of crores and risk systems that are specifically built to survive market crashes. And to them, your small order is just noise. So when you lose your few thousands or few lakhs, that money is going to the professionals that are running a multi-billion-dollar industry. In fact, just 6 months ago, a global trading firm called Jane Street manipulated the Nifty index using high-frequency trading algorithms. They made 36,500 crore in profits in just a few months. That is the scale of the machine you are quietly sitting across from every time you hit buy. When you zoom out, the picture is brutal. You're mostly playing a negative sum game against a multi-billion-dollar algorithm-driven institution. The probability that you will consistently out-trade them with your phone and a few YouTube videos advice is close to zero. All this information got me wondering, if the math is so bad, why is it that you and millions of other Indians still keep trading? I dived back into the SEBI report and found something very disturbing. You already know that 93% of all F&O traders lost money in 2024. Out of a total of 87.2 lakh investors, 65.4 lakh reported that their annual income was less than 5 lakh rupees. And on an average, they lost 1.2 lakh rupees per person. And 75% of these loss-making traders still continued trading the next year in F&O. Imagine losing more than a fifth of the money you earn all year and then still going back for more. This is the persistence paradox. The more you lose, the more you stick around, convinced that experience alone will eventually, someday, turn you into a winner. Part of this is also the sunk cost fallacy. Once you have invested money, time, courses, late nights on understanding charts, and public declarations that you are a trader now, quitting feels like admitting that all of that was for nothing. And your brain hates that. So it starts to tell you a nicer story. I am just one strategy away. I almost had it. Next trade will change everything. The more you lose, the more you think, I will flip a huge profit next time. And you stay endlessly stuck in that cycle. And just like in gambling, your brain is wired to remember the few big wins and forget the long, boring trail of losses. You see the few YouTubers who made it, not the thousands who blew up and went in losses and disappeared. The cruel twist is that even the winners at the top are not really safe. Now, in the mid-90s, some of the smartest people on Wall Street, they came together to build a hedge fund called Long-Term Capital Management. They even had Nobel Prize-winning economists that were working with them. They used extremely sophisticated mathematical models to exploit even tiny mispricings between securities with the promise of almost eliminating all the risk. For a few years, it worked beautifully. They generated huge returns, attracted billions of dollars, and they became legends in finance. But in 1998, when Russia defaulted on its debt, markets moved in ways that their genius models also said were almost impossible. As they were losing hundreds of millions a day, the same models kept telling them to hold on and even double down. In the end, LTCM lost around $4.6 billion, needed a bailout, and was effectively wiped out. This all happened because their models could not predict that it was a black swan event. A black swan event is a rare, unpredictable occurrence with massive consequences that seems obvious only when you look at it in hindsight. The COVID pandemic, financial crash of 2008, the Harshad Mehta scam, they were all black swan events. But why should this matter to you? Because if people with Nobel Prizes, unlimited data, and access to massive capital can still be destroyed by events that their equations did not predict, then your belief that if I am just smart and disciplined enough, I will beat the system is at best wishful thinking. So you are trapped between two hard truths. On one side, you are up against industrial scale firms and algorithms who can harvest tiny edges at massive volume. On the other, your own psychology, sunk costs, identity, and your biases keep pulling you back into the game even when the data clearly shows that you are losing. That is why day trading for most people is not really a path to freedom. It is a puzzle that looks tempting and solvable from the outside, but the deeper you go, the more the pieces refuse to fit. So the question remains, should you ever do trading or not? All of this does not mean that you can never make money in trading. There are a lot of traders who understand and analyze the market really well. But the difference between most people and them is that they don't treat the market as a sure-shot way to get rich quickly. In fact, Nitin Kamath said himself that trading is the toughest way to make money. The reality is much more boring. Wealth is built slowly through compounding, value investing, and ridiculous amounts of patience. Rakesh Jhunjhunwala made most of his money after the age of 50. He held on to good stocks for decades until they eventually paid off. So if you are watching this and wondering, okay, then what should I actually do? Here's the framework. 1. Invest by analyzing the real value of a company over years, not days. Look at their profits, debt, industry, and macro factors instead of just their price charts. 2. Diversify your portfolio so that one bad bet cannot destroy your entire future. 3. Hedge your risk. When it comes to investing in risky assets like F&O and cryptocurrencies, you should invest a percentage of your money that you from day one will be okay to lose. Experiment with a small portion of your savings and never ever put your entire savings into trades that can go to zero. 4. And the most importantly, wait. Let time and compounding work. Don't obsess over daily price moves or panic every time the market falls for a week. So here's the choice in front of you. You can keep chasing the dream of beating algorithms, hedge funds, and market makers with a mobile app and a few YouTube video recommendations, or you can quietly build real wealth the way 99% of successful people actually did, slowly, steadily, and safely. If you still want to trade after watching this, go ahead, but let trading sit on top of a solid long-term plan. Do not let it replace it. The market will always be there. The question is, do you want to be the person who burns out in 3 years chasing jackpots, or the person who wakes up in 20 years and realizes that their boring plan quietly made them financially free.